Let's talk about Netflix. Now, if you don't know what Netflix does, then I don't know why you're watching this. In fact, you're probably not watching this if you don't know what Netflix does because you probably don't have the internet. But anyway, just for kicks, Netflix is the world's leading internet television network with over 100 million members in over 190 countries, enjoying more than 125 million hours of TV shows and movies per day, including original series, documentaries, and feature films. Members can watch as much as they want, anytime, anywhere, on nearly any internet-connected screen. Members can play, pause, and resume watching all without commercials or commitments. And that's exactly why we love Netflix, because you can binge watch a whole season of House of Cards in one sitting, commercial-free. Who doesn't want that? Now, as stated in the company profile, Netflix has over 100 million members worldwide, a milestone they reached back in April. 10 years ago, Netflix had 7.5 million members and didn't start their service in international markets until 2010. And whilst the number of US memberships is still ahead of their international memberships, that is set to change sometime this year. At the end of the first quarter of 2017, US memberships were up approximately 8.5% from a year ago, whilst international was up 38.5%. So clearly international is where the growth is, as you would expect given the high penetration in the US already. Now, revenue growth has been impressive over the last 10 years or so at an average annual rate of about 25%. Profits, however, have grown at a little less than half that rate. No doubt investing in new content and expansion has dented profitability. In fact, for the last 2 years, the company's had negative operating cash flow, and in their last quarterly statement, Netflix said they expected $2 billion negative cash flow for 2017. Also, quote, negative near-term free cash flow is the result of the big increases in our original content combined with small but growing operating margins. Since we want our operating margins to grow slowly so we can spend enough to quickly grow revenue and original content, we anticipate negative free cash flow to accompany our rapid growth for many years. So ordinarily, negative free cash flow is not a desirable position to be in, but as the company indicates, negative cash flow is a result of investing heavily in the business. The company is quite clearly in a growth phase. And so if you're a long-term investor in Netflix, you might wave away near-term negative cash flow, and you might be comfortable with the fact that the company's trading on more than 140 times this year's earnings because the growth in the out years justifies the price today. But there are some classic problems with this type of thinking. It's an unfortunate artifact of history that investor confidence about the future reaches its heights at precisely the worst times. The obvious example was at the height of the tech boom in early 2000. Investors, or more accurately, speculators, were throwing money at stocks that had no earnings because the future was bright because of the internet revolution or something. The tech-laden Nasdaq then proceeded to lose 83% of its value over the next 2.5 years. Now, I'm not saying that Netflix is the same as a fly-by-night tech stock that has no earnings and no viable business plan. Clearly, it isn't. What I'm saying is that the price you pay matters. I agree, Netflix has great prospects, but how much of that is built into the current price at 140 times this year's earnings? You might run your own discounted cash flow valuation on Netflix and determine that $146 a share is a decent price to pay for Netflix today for what it will return you over the next 10 years or more. But you also have to ask yourself, are you willing to hold it for that long? Can you withstand a drawdown of 40, 50, 60% or more in the interim? Can you look over the valley and ignore the steep drop in between? Back in 2000, market darlings Cisco, Intel, Oracle and Microsoft were all profitable companies. All had PE ratios in excess of 100 times earnings, and all subsequently toppled between 65 and 90% by the end of the tech wreck. Microsoft made 85 cents a share in 2000. This year they're expected to make $3 a share, and yet the stock price is only 70% higher than it was 17.5 years ago. That's an average annual return of about 4%, not including dividends. Oracle's annual return since its high in 2000 has been about 1% annually, excluding dividends, and Intel and Cisco are still way below where they were in 2000. Now again, I'm not suggesting that Netflix is going to be a repeat of Cisco or Microsoft, but it's worth bearing in mind what you pay for stock today and how much of future expectations is already built in. People will often use Amazon as an example of a company that traded on an astronomical PE for years whilst they made very little money. And that's absolutely right. But they also neglect to add that during the dot-com meltdown, Amazon fell top to bottom 94%. Then during the most recent bear market, Amazon declined 65%, even as they made record profits in 2008. And sure, if you'd held Amazon through both the dot-com crisis and the financial crisis, you would have made out like a bandit given where the price is today. But the reality is very few people would have done that. Back in 1960, the average holding period for a stock was over 8 years. In 2013, it was estimated at about 4 months. The World Bank in 2015 said it was about 8 months. No doubt the internet and high-frequency trading has something to do with that. But in 2000, the average holding period had already fallen to about a year. The fact is, very few people stay for the long haul, and almost no one gets in at the bottom and out at the top. Yes, if only you had bought Amazon at $6 a share in 2001, you'd have made more than 160 times your money. If only. It very rarely works that way. Now, I'm not saying go out and short Netflix or Amazon today. I'm just saying be careful about committing new money to stocks that have an enormous amount of optimistic projections built in, especially given that this half cycle has driven stock prices to their second most extreme level of valuation in US stock market history. This bull market is now more than 8 years old, so you have to ask yourself, if you hold a stock like Netflix, are you prepared to watch it get cut in half or more over the completion of the current cycle? A lot of people will answer yes to that question, but it's quite a different story when a bear market gets underway. Investors don't like watching their stocks go down week after week, month after month. They start to shorten their time horizons, they stop looking over the valley and start looking at the plunge off the cliff below. Eventually they panic and then ultimately get out at any price because they can't stand the pain. So whilst I like Netflix as a company and I think it has tremendous growth prospects, you have to ask yourself, are you willing to hold it as a long-term investment and ignore the short-term gyrations? And even more importantly, it matters what price you pay for it. As famed bond investor Howard Marks said, no asset is so good that it can't become a bad investment if bought at too high a price. So do you think Netflix is a reasonably priced investment today given its future prospects? Let me know your thoughts in the comments below. I'll see you next time.